Hello and welcome to today's episode. The episode will tell you about ratio analysis. We have discussed ratio analysis in brief in earlier episode also, but in this episode we will discuss in detail. I am Garima Surana and the script is written by Dr. Arshia Hussain, teaching in the Center for Management Studies, Jamia Millia Islamia University, New Delhi. Ratio analysis is one of the important and widely used techniques of financial analysis. A ratio expresses relationship of one figure with any relevant figure. It is defined as one number expressed in relation to another number. Ratios are guidelines or shortcuts that are useful in evaluating the financial position and operations of a company and in comparing them to previous years or to other companies. According to Belvard E. Needles, the primary purpose of ratios is to point out areas for further investigation. They should be used in connection with a general understanding of the company and its environment. An accounting ratio signifies numerical or mathematical relationship between two relevant items contained in the income statement or balance sheet. Ratio analysis is a process of determining and interpreting relationship between the items of financial statements so as to provide a meaningful understanding of the performance and financial position of a business enterprise. According to Myers, ratio analysis is a study of relationship among various financial factors in a business. Financial ratios are computed and published by many companies in their annual reports to show their performance and financial position. A ratio expresses the relationship of one figure with any other figure. It may be defined as one number expressed in relation to other number. Thus, an accounting ratio shows the mathematical relationship between two relevant items contained in the income statement or balance sheet. For instance, the relationship between gross profit and sales, which means that volume of sales directly affects the amount of gross profit. Higher the volume of sales, higher will be the gross profit and vice versa. Thus, accounting ratio attempts to compute relevant relationship between two items of financial statements and interprets them for the purpose of decision making. Ratio analysis as a technique of financial analysis serves the following main advantages. First, ratio analysis as a method of financial analysis reduces the huge related accounting figures to a single figure which is easy to understand and remember. Second, the ratio analysis technique is a better technique as compared to other methods of financial analysis. It reveals the financial position of the company. This helps the investors and the lenders in making investment and lending decisions. Third, the ratio analysis technique is very important to management. It helps management in planning, communication, coordination, and control. Accounting ratios help in planning future activities of the business. The ideal ratio may be used for the purpose of comparison and taking corrective action wherever necessary. Fourth, the management can make inter-firm comparison on the basis of the ratios. Comparisons can be made between the two firms in the same industry or for one firm over a number of years to measure profitability. It helps in locating weak spots of the business and thereby helps the management in taking the remedial measures to correct the situation. Fifth, ratio analysis helps the management in determining the operating efficiency with which the firm is utilizing its various assets in generating sales revenue, which can be done with the help of activity ratios. Ratio analysis suffers from many limitations which should be properly recognized by the financial analyst in the computation and application of ratios for interpretation and decision making. Computation of wrong accounting ratios may lead to erroneous results and thereby affecting the future plans of the business. Following are some of the limitations. First, the ratio analysis ignores the qualitative factors. For example, a customer may be granted a credit on the basis of the financial statements, but in reality, his character, that is, intention to repay and credit worthiness, may be doubtful. Second, changes in the price level often make comparison of figures for various years difficult. Thus, accounting ratios cannot be said to be fit for the purpose of comparison if the price level changes have not been incorporated in the financial statements. Hence, the figures of the past years must be adjusted in the light of price level changes before comparing the ratios of these years. The incorporation of price level changes in the financial statements is itself a problem. Third, the ratio analysis is based on historical information since they are based on the financial statements which itself are historical in nature. It tells nothing about the future with which the management is specifically concerned. Fourth, there is no single standard ratio against which the actual ratio is measurable. Circumstances differ from firm to firm and the nature of each industry is different. Therefore, the standard will differ for each industry and the circumstances of each firm will have to be kept in mind. Fifth, accounting ratios as a tool of financial analysis cannot replace the original data on which they are based. Sometimes the consideration of absolute figures is highly important for understanding the underlying problem in proper form. Thus, the ratios can best be used as a complementary tool and not as a substitute to the basic information. Sixth, the success in computation and interpretation of accounting ratios basically depends upon the knowledge and experience of the analyst. Thus, interpretation of ratios is a technical and sensitive job which can be performed only by an experienced financial analyst. A financial analyst can interpret the accounting ratios in the following ways. Individual ratios should be interpreted with reference to other related ratios due to the reason that an individual ratio does not throw much light on the nature and significance of the problem under study. For instance, a current ratio of 2:1 indicates that a firm is able to meet its current liabilities and also have sufficient amount to meet its working capital requirements. But the ratio does not provide any idea about the composition of current assets. Thus, it should be interpreted in relation to other ratios. The study of other related ratios is more helpful for drawing dependable conclusions. For proper understanding of the current economic position of any enterprise, a group ratios approach should be used simultaneously, such as asset test ratio, assets turnover ratio, and debtors turnover ratio. Trend of ratios should be used for interpretation. It means that ratios for the past few years should be compiled and presented in a tabular form. The table shows the trend, which will give a better idea about the problem under study. Interpretation of ratios based on trend is more reliable than the one based on individual ratio approach. A ratio may be interpreted in terms of the other related ratio of other similar nature firms. Industry ratios can be used as a base or model for the comparison with one's own firm's ratios. Financial analysts come across a large number of ratios which are used for analyzing different types of problems. Ratios have been classified in various groups according to statements, time, importance, functions, users, or purpose as follows. First, statements on the basis of classification. According to statement basis of classification, the ratios are grouped into categories such as A. Income statement. Ratios which are derived from the data of income statement alone. B. Balance sheet ratios, which are accounting ratios of balance sheet only. And interstatement ratios, which use one figure from the income statement and another from the balance sheet. Second, time-based classification. According to time as a basis of classification, the ratios may be put into two groups. A. Structural ratios, such as ratios based on the income statement and balance sheet for a particular period of time. B. Trend ratios, ratios which relate to past years and show trend over those years. Third, importance as basis of classification. Importance as a basis of classification suggests two types of ratios. A. Primary ratios, ratios which serve the primary purpose of understanding the profitability on turnover or capital employed. B. Secondary ratios, ratios which are computed to understand the primary ratios. These ratios are also known as secondary ratios. For example, ratio of cost of sales to sales is calculated to understand the profitability in a better way. Fourth, purpose as a basis of classification. Accounting ratios are computed to serve certain purpose of the various interested parties. Generally, the various parties are interested to know the profitability, liquidity, solvency, and activity of their concern. Accordingly, the ratios are classified into the following four groups. First, liquidity ratios. Second, solvency ratios. Third, activity ratios. And fourth, profitability ratios. Now we will discuss the accounting ratios in detail. Liquidity ratios measure the short-term solvency of a business concern. These ratios measure the firm's ability to pay its current liabilities as and when they fall due. Liquidity ratios are of two types. First, current ratios. Second, quick ratios. Current ratios. Current ratio shows the relationship between current assets and current liabilities. It is calculated to assess the short-term financial position of the enterprise. Current assets are those assets which are either in the form of cash or cash equivalents in a short period of time, say within a year. Examples of current assets are cash in hand, bank balance, bills receivables, debtors, stock in trade, marketable securities short-term, prepaid expenses, short-term loans and advances, debit balance. Current liabilities are those liabilities which are to be repaid in a short period of time, say within a year. Examples of current liabilities are trade creditors, bills payable, bank overdraft, short-term loans and advances, credit balance, income received in advance, outstanding expenses, provision for taxation and proposed dividend. This ratio is calculated as follows. Current ratio is equals to current assets divided by current liabilities. Question 1. From the following information, calculate the current ratio. Stock rupees 15,000, bills receivable rupees 5,500, debtors rupees 14,000, bank rupees 9,000, cash rupees 6,000, creditors rupees 16,500, bills payable rupees 7,000, prepaid expenses rupees 500, debentures rupees 25,000, land and buildings rupees 60,000, provision for taxation rupees 1,500. Solution. Current ratio is equals to current assets divided by current liabilities. Current assets is equals to stock plus bills receivables plus debtors plus bank plus cash plus prepaid expenses is equals to 15,000 plus rupees 5,500 plus rupees 14,000 plus rupees 9,000 plus rupees 6,000 plus rupees 500 is equals to rupees 50,000. Current liabilities is equals to creditors plus bills payable plus provision for taxation is equals to 16,500 plus rupees 7,000 plus rupees 1,500 is equals to 25,000. Current ratio is equals to current assets divided by current liabilities is equals to 50,000 divided by rupees 25,000 is equals to 2 divided by 1. Current ratio is equals to 2:1. Question 2. From the following data, calculate current ratio. Liquid assets rupees 36,500, stock rupees 11,500, prepaid expenses rupees 2,000, working capital rupees 30,000. Solution. Current assets is equals to liquid assets plus stock plus prepaid expenses is equals to rupees 36,500 plus rupees 11,500 plus rupees 2,000 is equals to rupees 50,000. Current liabilities is equals to current assets minus working capital is equals to rupees 50,000 minus rupees 30,000 is equals to rupees 20,000. Current ratio is equals to current assets divided by current liabilities is equals to rupees 50,000 divided by rupees 20,000. Current ratio is equals to 2.5. Quick ratio or liquid ratio or acid test ratio. Quick ratio measures the short-term liquidity of the enterprise in its correct form. It shows the relationship between liquid assets and current liabilities. Quick assets are those assets which can be converted into cash immediately or at a short notice without a loss of value. It includes cash and bank balances, ready marketable securities, debtors and bills receivable, and short-term loans and advances. Inventories and prepaid expenses are not considered as quick assets. Quick assets is calculated as quick assets divided by current liabilities. 1:1 ratio is considered ideal ratio for a concern because it is wise to keep the liquid assets at least to the liquid liabilities at all times. Solvency ratios measure the long-term financial solvency of the concern. It measures the enterprise ability to pay the interest regularly and repay the principal on maturity. The following ratios are calculated to judge the long-term financial solvency of the concern. First, debt-equity ratios. Second, debt-total funds ratio. Third, interest coverage ratio. Debt-equity ratio. This ratio is calculated to measure the relative proportion of outsiders' funds and shareholders' funds invested in the company. This ratio is determined to ascertain the soundness of long-term financial policies of the company. The formula for calculating debt-equity ratio is long-term debts divided by shareholders' funds. Shareholders' funds is equals to preference share capital plus equity share capital plus profit and loss account credit balance, capital and revenue reserves plus reserves representing marked surplus like reserves for contingencies minus fictitious assets. Long-term debts is equals to long-term loans, both secured and unsecured, like debentures, bonds and loans from financial institutions. A low debt-equity ratio is considered as favorable from long-term creditors' point of view, as a low ratio would provide safety for the creditors. But the same ratio would be considered as unfavorable for the shareholders. Calculate debt-equity ratio from the following total assets: rupees 3 lakh, total debt rupees 4 lakhs, current liabilities rupees 2 lakhs. Solution: debt-equity ratio is equals to debt divided by equity debt is equals to total debt minus current liabilities is equals to rupees 4 lakhs minus rupees 2 lakhs is equals to rupees 2 lakhs. Equity is equals to total assets minus total debt is equals to rupees 3 lakhs minus rupees 2 lakhs is equals to rupees 1 lakh. Debt equity ratio is equals to debt divided by equity is equals to 2 lakh divided by 1 lakh is equals to 2:1. Second, debt total funds ratio. Debt total funds ratio shows the long-term financial solvency of a concern. In this ratio, the outsider's long-term liabilities are related to the total capitalization of the firm and not merely to the shareholders' funds. It is calculated as follows. Debt total funds ratio is equals to long-term debts divided by capital employed, where capital employed is equals to long-term debt plus shareholders' funds. Interest coverage ratio. This ratio measures a relationship between net profits before interest and taxes and interest on long-term debts. In other words, interest coverage ratio measures the ability of a concern to pay fixed interest charges as and when they become due for payment. This ratio is called debt service ratio, as it measures the debt servicing capacity of a concern. This is generally expressed in number of times. It can be calculated as interest coverage ratio is equals to net profits before interest and tax divided by periodic interest on long-term debts. Calculate interest coverage ratio from the following. Net income after interest and tax rupees 4,80,000, 10% debentures rupees 24 lakhs, tax rate 50%. Solution. Net profit before interest and tax is equals to net profit after interest and tax plus interest on 15% debentures plus tax is equals to rupees 4,80,000 plus 2,40,000 plus 4,80,000 is equals to rupees 12 lakhs. Interest coverage ratio is equals to rupees 12 lakhs divided by rupees 2,40,000 is equals to 5 times. Ratio analysis is one of the techniques of financial analysis. Accounting ratios are calculated and published by many companies in their annual reports to show their performance and financial position. Accounting ratios help in understanding and interpretation of financial statements, which helps the management in decision making. There are various types of accounting ratios: liquidity ratios, solvency ratios, activity ratios, and profitability ratios. In this episode, we discussed liquidity ratios and solvency ratios. That is all for today. We will discuss another topic of accounting in the next episode. Till then, goodbye.